If you have debt, the financial road is about to get bumpy. Your loan repayment will go higher. The Reserve Bank is trying to control the high inflation that has been above its target bracket of 3 to 6% for some time. The central bank says risks to the inflation outlook remain on the upside. This as a result of the effects of the Russia-Ukraine conflict pushing up oil prices. Electricity and other administered prices also remain upside risks. The bank's forecast for headline inflation for this year is unchanged at 6.5%.
What we do know, what is detrimental to the economy at the moment, is the rising cost of living, which is depicted through inflation. And that failure to deal with inflation now would be detrimental to the economy down the line. And that is what our focus is.
For indebted consumers, this is bad news, but for those with savings, this means they will be getting more in interest.
Those that are net borrowers, in other words, they have debt, whether it be vehicle finance or car debt or mortgages. Over time, the hikes in interest rates will accumulate and the impact will start to affect the demand for credit.
The central bank expects the local economy to grow by 1.9% this year, down from an earlier 2%. It says the negative global shocks and load shedding continue to create headwinds to growth.
Over the last 3 years, we estimate that the power shortfall has clipped growth by approximately 1 percentage point per year. This year, given that the power rationing, the power shortfall will eclipse anything we've seen over the last 15 or so years, it would not be fetched to assert that we will see the GDP outlook clipped, as I've suggested, by maybe 1.2, maybe even 1.3 of a percentage point.
It's expected the Reserve Bank will likely further hike the repo rate by about 50 basis points at its next meeting in November as it continues to tame inflation. Gloria Sefako Musi, SABC News, Johannesburg.